We are seeing U.S. stocks extending previous session gains after rallying in the previous session. This does come ahead of the release of the November core PCE. This is the Fed's preferred inflation measure, and it excludes food and energy prices. Stocks and crypto rallied yesterday after Trump moved away from tariffs on European countries and said there's a framework for a deal involving Greenland. This could lighten the impact of at least one geopolitical factor on the markets. Some that remain include Iran, Venezuela, and Supreme Court rulings on Trump's tariffs. There's also underlying Fed pressure regarding officials Cook and Powell. Joining me this morning is Bob Dahl, who is CEO and CIO at Crossmark Global Investments. Bob, great to have you here. Thank you so much for joining me. Well, as we kick off the new year, we've seen small and mid caps outperforming large caps in the month of January. So how do you view market breadth so far this year?
Certainly, as you intimated, it has improved, Remy. The small beating the big, the equal-weighted S&P beating the cap-weighted S&P. It started the back part of last year, as you know, but it's accelerated so far this year. We'll keep our eye on it. For the small to continue to lead, they're going to have to produce the earnings. At last check, as many as 40% of the Russell 2000 names, the small cap index, were losing money. So for this trade to continue, that number's got to drop significantly.
Yeah, and I think that's an important point you just made there, especially as we're looking at the outperformance of the Russell index. But when we're taking a look at the macro factors, in particular the data, we are just minutes away from the release of the Fed's preferred inflation gauge. So where do you see inflation standing and impacting the markets as well as the central bank?
I'd say several things. One, inflation has been sticky. It's averaged closer to a rounding of 3%, not 2%. And the Fed keeps saying 2%, 2%, 2%. One Fed governor about a year ago said, I didn't say 2, I said 2.0. I don't think we're going to get to 2.0 absent a recession. And so I think that's going to continue to be an issue. I think stocks at this PE of 22, 23 times is assuming that inflation will get down to that 2% level. So if it's closer to 3 than 2, that's not great news for valuation levels. So fingers crossed we can get lower inflation.
Yeah, and Bob, one thing I want to ask you about while I have you here is that 2026 is a midterm election year. And of course, we're continuing to monitor geopolitics as well as politics, especially surrounding the central bank here in the U.S. So how do you see all of this shaking out and impacting the markets?
Well, for starters, the history says that of the 4 years of a presidential cycle, the second year, this year, is the year that GDP is usually the strongest, and we're expecting a noticeable acceleration in growth this year over last with the tailwind of that one big beautiful bill. However, the second year of presidential term is also historically the worst from a stock market standpoint, and so I think it's going to be tougher to make money this year. Growth will probably be pretty good. Hopefully earnings will too. PEs have to hold up at these levels or expand to get another double-digit year. That would make 4 in a row. 4 in a row has only happened, as you probably know, once in the last 100 years here in the U.S. So fingers crossed, but we need some good news to get there.
Yeah, and speaking of year-to-date gains, one asset class that did outperform U.S. stocks, of course, is gold, in addition to silver. So not only did we see double-digit, but we saw triple-digit percentage gains for gold and silver. And this year, we're seeing copper hit records. So what is your take on metals after the record run?
Well, first of all, I think metals are telling us that U.S. and global economic growth is likely to improve this year. Now, as in terms of those three in particular, my preference is industrial metals. So copper, copper's done well, but gold and silver have done even better for a longer period of time. After the flagpoles in gold and silver, we had that correction a few months ago, and they've come back on. I think in this area, we're probably going to see more volatility in both directions for those two metals.
And finally, before I let you go, what is your overall take on where the markets are heading in 2026? And for Americans out there who are watching right now, what would you say to them in terms of what we can expect in the year ahead?
I'd say don't expect what you got the last 3 years, double digits, but doesn't mean you can't make money. I think it's just going to be harder to make money this year. You're going to have to focus on companies that have strong and improving earnings growth, have reasonable cash flows, and have reasonable profitability return on equity. You stick with those kinds of companies, I think you'll do okay, but it's going to be bumpier ride than the last few years.
Well, Bob, great having you on the show today. Thank you so much for joining us, and thank you so much for sharing all of your insights.
Thanks, Remy.